If you can master supply and demand, you'll be able to trade alongside smart money. Stop getting caught on the wrong side of the market and take loads of high risk reward trades with high levels of accuracy. In this video, I'm going to reveal to you the 5 truths about supply and demand that 99% of other traders will never understand, and that my students have collectively used to go on and make hundreds of thousands of dollars in verified trading profits. This video will tell you what is supply and demand, how to read institutional order flow, how to accurately draw your supply and demand zones, how to find high probability zones that actually work, and then finally, how to enter and exit trades for large profits. Okay, so first things first, I want to explain to you what is supply and demand and how it actually controls the price of everything. So in case you didn't know, supply and demand is literally pretty much what controls the price of absolutely everything that you can think of, all right? Bar maybe some luxury goods that are based on psychological scarcity. So let me explain to you supply and demand using this simple chart that we have right here, and also how it directly relates to trading. On the left here, we have price. Along the bottom, we have quantity. Every market that you trade, Forex, indices, crypto, whatever it may be, lives on this exact relationship. This downward line here, this line here is demand, and demand represents buyers. The higher that price goes, the fewer buyers are willing to buy. And the lower that price goes, the more buyers are willing to step in. This is why demand slopes downwards. This line here represents supply, and supply represents sellers. At low prices, sellers aren't interested. At higher prices, sellers are motivated. This is why supply slopes upwards. At this point in the middle, this is what we call fair value. This is the only price where buyers and sellers agree. In trading terms, this is balance. When price goes above fair value, sellers are happy, but buyers aren't. There's too much supply and not enough demand. So naturally, price wants to move down. When price trades far below fair value, buyers are excited, but sellers aren't. And therefore, there is too much demand and not enough supply. And so naturally, price wants to move up. And so you can visually represent this like this, right? Let's say we have a price chart. When price gets too far above perceived fair value, so when we go into this exploration phase after a range, essentially at this point in time, buyers aren't really interested. They're not really motivated to keep buying, but sellers are very interested and motivated to sell. So because supply outweighs demand, price naturally gravitates back to fair value. When we trade below fair value, typically what we see is that buyers are ultimately very motivated to buy in here, but sellers are less motivated to sell at these levels. And so naturally, price will start to gravitate more toward fair value. This is ultimately how a market is created, right? It's what a chart looks like. Behind the candlesticks that you see, there is a story that we are being told about supply and demand and its relation to price. This is literally the entire reason that a market moves. Price does not move randomly. It moves to correct imbalance and pauses at balance. That's again why you see price move in such a way where once it becomes imbalanced, price naturally wants to correct back to balance. And you know a balanced price range when you see a lot of price ranging around. When you see a range in price, usually this means that price is pretty balanced. Sellers and buyers are both pretty happy, and this is what we call fair value. The moment that price moves away aggressively like so, price becomes imbalanced, right? It's above fair value. And if you've ever seen a fair value gap, then essentially this is what we're referring to. A fair value gap is an indication of an imbalanced market. The market is always going from areas of balance to areas of imbalance. And its job is to find new balance at this level or to rebalance at old balanced levels. This is why the market always looks like this. As traders, it's not our job to predict the future. We are simply identifying where supply or demand is likely to overwhelm the other and positioning ourselves around those areas. That is literally it. Every strategy, every indicator, and every model that you've ever seen is built on this foundation. If you understand this, you understand markets. And from there, everything else is the smaller details and refinements that allow you to trade profitably consistently. And those are the details we're going to go into right now. Okay, let's take a quick break just for 1 second because I want to share a golden opportunity. You see, after you finish this video, I've left you another free masterclass, a 45-minute masterclass on how you can guarantee that you'll become profitable this year. I'll leave the link down in the description. Enjoy this video, and after, go ahead and check it out. So now we're going to be looking at institutional order flow, right? This is how a market actually works behind your candlesticks. So this is what the order book actually looks like. When you see a candlestick going up or a candlestick going down, beneath this candlestick is this, right? Which is what we call the depth of market or the order flow, whatever you want to refer to it as. In the order book, we have the bid, which is the buyers, and we have the ask, which is the sellers, right? Just think of it as if you are a bidder, you're bidding on something, you're buying that thing, or you're willing to buy that thing. If you're setting an ask price, you're the one that's selling for something. You are asking for this amount for the product that you have. So you already have the thing, and as a bidder, you don't have the thing, right? Very simple terms. When someone hits the bid, they are wanting to buy. When someone hits the ask, they are wanting to sell to a bidder. Obviously, for a market to work, every bid must have an ask and every ask must have a bid, right? That's how a market works. You cannot have a market where you have only the ask and no bid. So at any one point of time, we have two participants in the market. We have the aggressive and we have the passive. Passive liquidity looks like this. So the current price is 1.5. Let's just say this is the current price. Let's say you were an aggressive buyer, and let's say price was 1.5 right now. If you were an aggressive buyer, you would essentially have to go and find the most readily available seller. And so you would have to go and meet a seller of this, which is the ask. So if you were an aggressive bid, you would go and bid on the most recent ask, which in this case, let's say it's 1.6. So let's say we have a passive seller, right, who is sitting at 1.6, and at 1.6, let's say they have 7 lots available. And let's say there's another passive seller at 1.7 who has 3 lots available, right? So if you were an aggressive buyer, price is at 1.5, and you want to hit the bid for 10 lots, here's what would happen. You would get filled your first 7 lots at 1.6, right? And then these 7 lots in here become 0. Then your next lot of liquidity, which is the 3 lots that are remaining, would get triggered at 1.7, right? And then this would get cleared and this would be left at 0. And now the current price would be at 1.7, which is like this, right? This is how you see a candle. You have the open of the candle and you have the current high of the candle. Now let's say the bid starts filling back up with more passive buyers. So you was the passive buyer at 1.3. You see that price is increasing. Now maybe you change your mind, for example. Now let's say you're like, oh crap, I'm probably not going to get my order filled at this price point. Let me add my passive order. Let's go to 1.5. And so now let's say you place your order again at 1.5. You would be now sitting here in the order book. Now let's say, for example, we get an aggressive seller step into the market at 1.7. And let's say this aggressive seller has 15 lots that it wants to transact. So that seller will transact those 15 lots to the most recent bids, right? The passive liquidity that sits in the bids. And so where would that be? Well, we're at 1.7. Let's say there was 0 lots available at 1.7. Price would skip from 1.7 down to 1.6. Let's say there's no liquidity at 1.6. Price would skip back down to 1.5, right? And then you would see a wick form. Notice that there's a wick a price. This represents the highest level that price has been at. Now we have that wick form. And so you're available at 1.5, right? For 10 lots. So now your 10 lots get triggered. You get filled at your price that you wanted to get filled at, and price continues going lower to the next available liquidity. Let's say it's at 1.4, and let's say there are 5 lots available. Price would travel like so down to this 1.4 level. This candle would then become a bearish candle with a wick on the buy side. That's how a candle is formed. Now we're at 1.4, right? Which is where the aggressive seller got their entire position filled at. So they wanted to sell at 1.7 and their entire order was filled, and the filling of that order was finished at 1.4, right? Giving them somewhere in the average fill value of around 155, something along those lines. That is essentially what we experience when we get slippage. You get slipped when there isn't the available liquidity for you at your specific point, right? That's why we experience slippage. And this is how a market is made. That's how a candlestick is formed. That's how a candle goes up and down, up and down. Now on a lower time frame, let's say for example, this was the daily candle that was forming. On a lower time frame, what's actually happening is price started at 1.5, right? And then it made its way up to 1.7, and then it traded its way back down to 1.4. And so on a daily time frame, you just get this one candle building out. But on a lower time frame, what we're seeing is what we've just gone through on a massive scale. So instead of it just being me and a couple of others bidding, we're talking about thousands, if not millions of different transactions coming in. And so now you can see how this becomes complicated between the supply and demand, and also how we see all of these small little ticks in price every second. That's because what is going on in this very simplified explanation that I've just walked you through is going on a massive scale deep inside of the order book, right? With millions of market participants. And so that is how a candlestick is formed. And that is also how one candlestick is formed. If you zoom into that candlestick, you will see on the lower time frames, you'll see an entire narrative of price performing with structure and highs and lows and all this sort of stuff. That is how price moves. And all of this is simply the supply and the demand. The supply is the ask and the demand is the bid. And there are two different types. There is aggressive and there is passive. The aggressors attack the ask. If you're an aggressive buyer, you attack the ask. You don't wait for price to come to you, you go to price and you're willing to buy at that price right now. If you're a passive buyer, you're sitting and waiting for price to come to you, and vice versa. If you are an aggressive seller, right, you're attacking the bid. You're going to find the most recent buyer. You're showing up to him and you're presenting your offer to him. If you're a passive seller, you're waiting for the buyer to come and find you. And if they don't find you, no problem. I don't get filled on my position. If they do find me, I do, right? That is the difference. And the price the aggressive participants have to pay is usually some form of slippage, or could be some form of slippage. Okay, so if all of that was maybe a little bit confusing, hang in there with me because I'm about to simplify it so much more. So now we're going to walk through how to identify institutional levels of supply and demand in a simple price action chart. So it's very simple. What we just explained is that price is always going from balance to out of balance. So how to identify supply and demand is very simple. In this instance, we can see that price is trading higher, which means that demand is in control. Now, all you need to identify a range in price followed by an aggressive expansion. This will give you a demand zone, because what we can see here is that this range in price, as we've already explained, there is a relative equal level of supply and demand at this level. The reason that price is ranging so well is because buyers and sellers are agreeing on price at this level, and a lot of transactions are able to take place. This is an area of balance, right? When price is like this is usually an area of balance. And then what happens? Out of nowhere, price aggressively runs into one direction, completely moving out of balance and into expansion. In this instance, that expansion is bullish. So price is trading higher, which simply means there is more demand than there is supply. That is why price is continuously moving higher. Price is going to try to find sellers, right? There is an abundance of buy liquidity that is available in the market. Price needs to go and balance that buy liquidity with sell side liquidity. And so price is hunting for sellers to fill their orders out. That is why we move out of balance into imbalance. Now what we do is we take the trading range in here that we were gravitating towards. We take the trading range that we were gravitating inside of. This was the previous area of fair balance. This area now becomes a demand zone, right? Why? Because demand originated from here. This is where the area of demand originated from. And I'll tell you a little something. When you understand institutions, large level players, these are institutions that are trading with so much capital that it's very difficult for them to fill their orders. What I mean by that is we just explained how the market works. So if you was a institution and let's say you had, 10,000 lots that you needed to trade and you had a target for those 10,000 lots. You can't just go to the market and dump your 10,000 lots into the market and buy 10,000 lots of $1. Why? Because of your 10,000 lots, you'll probably get some here, 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 some here. because it's such a large volume, you will end up taking the market from down here to up here for you to trade this 10,000 lots. Because for you to buy 10,000 lots, you need to find 10,000 lots in supply. And there may not be 10,000 lots in supply right here. There may be 1,000 here, 1,000 here, 1,000 here, 1,000 here, 1,000 here, 1,000 here. So if you deploy it all right now, the price is just going to explode because it's just going to keep running up on the ask side to say, hey, who's got lots for me? Essentially, it's going into discovery phase. Who's got the lots for me? I need to fill my trade. And this trader then, who's trading these 10,000 lots inside of this institution, gets a very bad fill. Let's say they wanted to fill, they have a target. They get into the markets in the morning, they say, hey, today my objective is to fill 10,000 lots at 1 EU, right? 1 euro dollar. And if they just dump all their order in at 1, they'll probably get their average order value at, let's say, for example, 1.5. That's a terrible job. So they didn't hit their target of getting filled at 1, they got filled at 1.5 because they dumped all their liquidity in now. Instead, what these institutions will do, they will find an area of balance where price is accepting. And what they will do is they will slowly sneak their orders into this area of balance. They'll place 1,000 in here, wait a little bit, price finds balance, 1,000 in here, price shoots up, it's respected, we find more balance, they'll put 1,000 in. And so they load up in these areas. This is the load up phase for a large institution to fill a large order. That's the only way that they're going to get all of their order filled at the price they want it to be filled at. And then once their order is filled at that level, that is when their job is complete. And so in these areas of ranges, this is where you will see institutions build up on price. And then let's say that trader was on the right train, right? Price then extrapolates into this direction. It expands into this bullish direction. Now this area of price holds a level of demand because there is a lot of demand for price at this level, right? As clearly seen. And the fact that price aggressively expands so high insinuates that all of the demand was not filled at the best available price. So let's say in another scenario, this same trader with the same goal of filling 10,000 lots at this level, which is what happens most of the time, they get that target and price is in balance. And whilst price is inside of this balance, maybe he only gets to expand 6,500 lots. And then all of a sudden, because he was buying so much, there wasn't any sell liquidity at this level anymore. Sellers become exhausted. There's no one willing to sell this level anymore. And so price goes into search for sellers. That trader is not happy about trying to fill the rest of his order in this price leg. So what he does is he waits and he sets himself as a passive buyer at this same price point for his remaining 3,500 lots. What happens? Price goes outside of the balance range. Price usually gravitates back toward the balance range. And when price hits this level, guess who is there waiting? Mr. 10,000 lots is still not triggered his whole order. So when price comes back in and sellers are moving through the price, there is just this large 3,500 lot order holding this price until eventually the sellers who are trying to push price lower and sell at these levels get exhausted. Once they get exhausted, the sell side of the order book becomes thin and buyers instinctively just push price higher. And that just happens as an automatic process. That is why these demand zones, when you find the correct ones, they hold. And you will know it's an institutional level of supply and demand if you see these large ranges and then massive expansions out of that level. That is how you actually identify an area of institutional supply and demand. Now let me show you this in a real example. Okay, let's take this price chart here. What do we see that has happened right here? I will tell you very simply, what we see is that price was in a range of balance, and then price boomed up into here, moving price out of balance. It's as simple as that. We had fair value and we moved out of fair value. Who is dominating in this transaction? Obviously buyers, right? Demand outweighs supply. That's why price has gone and traded higher, right? So then this level in here would be your demand level, right? And this is how I would draw it. This in here would be your area of demand. And so you can draw this across here and notice that price goes from searching, failing to find new accepted balance, and it comes back into this area of demand. And then what happens at this level? Here is our demand. Here is our expansion out. Price comes back to this level, right? Sellers are trying to attack this level. Failure to do so. And then price has the continuation expansion from this area of price. This area of price is very clearly and obviously an institutional area of demand. Okay, now what I'm going to show you is how to identify high probability supply and demand. Simply put, supply and demand zones are everywhere in the market. How can we truly understand which ones have a higher chance of working than others? And the way that I have found through years of the data that I have gathered on this specific concept, I found one thing stands out above all else about how to truly understand whether a supply and demand zone will actually work. And that is structure, institutional order flow, right? The actual market structure of price. And so notice in this price level here, what do we have? Price starts up here, right? Price comes down. We have a low. There's a low in price. Price puts in a lower high. This high is lower than the previous high. That's already a bearish indication. Price then puts in a lower low. This low is lower than the previous low. At this point in time, it is very clear and obvious that price is bearish. So the overall flow of orders are bearish. So we have a lower low, price comes in again, price puts in a lower high. Or in fact, price doesn't put in a lower high. Price liquidates the high. That's an even clearer sign for me. When price takes out an old high, but with a wick, and we then close down here, that to me is a massive indication of market reversal. So we have bearish trend plus a market reversal indication, and then we have another take of the low. So when I'm coming into the market each day, I want to understand just the simple current trend. So we have a swing high and we have a swing low down here. Now, I find that the best way to do things, right? Let's say I play price out like this. What you'll notice here, there is both a demand zone and a supply zone, right? Very clearly. How do I know that? Well, you can see that price was in a very tight range in here and then had a very aggressive sell-off. So this is going to be our supply zone. You can just take a low to a high inside that range and pull that across. That's going to be a supply zone. Then at the bottom of this supply zone, price finds another range. We'll take the low to the high of the range, and then we have aggressive buy out of that level. So we have demand in here and we have supply in here. And so let's say the supply trader has their levels in here and they want to take out this low. And let's say the demand trader has their levels in here and wants to take out the sellers, right? This person's betting on demand. This person is betting on supply. Now, the higher probability of who is going to win this battle is the one who is trading with the trend, right? Very simply put. So the trend here is bearish. So therefore, the higher probability is that the supply level is the one that holds and the demand level is the one that gets traded through. Now, this demand might hold momentarily, but eventually this demand zone will lose. And that's what we see happen in this example. We see that the supply zone is reached. On multiple occasions, this supply zone gets reached. We reach in, buyers try to attack it again, and both of the times they fail. Now we find ourselves approaching this demand level. Demand reacts and immediately trades straight through it. And so if we remove both of these, we will see that the supply that's in alignment with the trend will always outweigh the demand that is against the trend. Here's another example that happens shortly after. What we can see here is that price is very clearly bullish, right? We have a break of structure across here. And so we have our swing low and our swing high. Notice that price in general in this area is in pretty much a balanced price range. At some point in time, price becomes out of balance, right? We've gone from the range of this level to out of this level. What you'll notice is that there's this massive range and the expansion. And so you can literally take, right, whatever of this range you would like to take. You can take this entire level if you would like to. This is going to be your demand zone. And again, very clearly, if you're a buyer of this demand zone and simply just taking out the highs, again, obviously I do not trade with a 1-to-1 risk reward ratio. It's just the purpose of showing you. You'll notice that price comes straight into our demand zone. and then straight out of the demand zone. Notice that again, even this in of itself, right? Prices had this long range for a while and now it's expanded out above this highs. Even this entire zone in general, this is an institutional level of demand. And so it's expected that this level will probably hold itself and continue trading higher from this specific level. Right? And that's ultimately what happens, because this entire level in here really acts as a demand range that builds up, we expand out, we come back in, we build up, we expand out. Okay, now we'll put everything together and walk through how we will actually enter and exit using everything that we have just learned here in this video. So before we actually even identify supply and demand, as we explained, how to identify high probability supply and demand is based actually on the market structure. So the first thing that you must do when you come into the market is identify your current trend. And so I like to use the 15-minute time frame on Euro US dollar. And so what we can see is that price was actually very bullish, right? We see that price puts in a high, a low, higher lows, right? It's putting in consistently higher prices until eventually we have a high in here that puts in a low down here, that puts in a new high up here, right? So this is a bullish break of structure. At this point, price was very bullish. And then price breaks those lows down here and we actually shift bearish. So we were bullish and now we're actually bearish. The high in here and the low down here. So first things first, we take out this and we're going to put our low in here and our high in here. Now, to me, nothing matters other than me being a seller of this market. And how I want to do that is first identify the trend, which we've just done. Second, then identify the area of supply. And for me in this instance, the supply is obvious, right? What do we have? We have a very range-bound price before aggressive expansion. So we have everything we just looked for, our range and then expansion. So inside of our range is our institutional area of supply. But I'm not going to just try to take this level, right? Because I would be basically trading this, my stop loss here and my execution up in here, right? That's not really what I'm looking for. 1 to 1.57 risk to reward. That's not what I want. I don't want to risk $1,000 to make $1,570. No way. So what I do is I mark out these zones like this, right? I will just mark out this as a supply zone, right? Very easy area of supply. And I will just wait for price to get into that zone. So here you can see that price gets into my zone. And instead of just trading from this level, right, which is what we just looked at, instead of just taking this trade, which is very low risk to reward, what I will do is I will wait for confirmation. And so I will go to a 1 minute time frame and I'll look at the market structure on the 1 minute time frame. Notice that as price makes its way up to this gray box, which is our supply, notice that the 1 minute time frame is very bullish, right? And so what I wait for is I wait for a shift. I wait for the price to tell me that this area of price is confirmed. And so price is bullish, right? And then eventually when price shifts, that would be my confirmation. And at this point, that's when I can be a confirmed seller of price. And so now I need to find my level. And my level is very simple. I'll go to a 5 minute time frame and I will just use this specific order block, right? This final buy to sell, because this is the area that everything changed. This is the area that price went from demand in control to supply in control. And I want to find the last level of demand that was in control and where the supply came in. And that's what I want to use. I want to use this level as my entry point, right? And so that becomes my entry, just like this. And I'm pretty sure, yeah, price doesn't even hit it. So I wouldn't even go into the trade. And so this tells me that the order flow has shifted. Because remember the order book that we showed earlier, what we're seeing here is that demand is consistently taking control, right? Price is just going higher and higher and higher in the order book until sellers take control, right? Which is this high here. And then all I need to really do is just find the area. You can literally just use the entire range. I can take the low to the high of this level like this, draw this across, and I can use that as my entry point. That can be my entry, right? There's no problem. That's a 5 pip stop loss. And so now notice the difference. Nothing changes. I'm taking the same target, right? And pretty much all of my trades are 1 to 5 risk reward. And so nothing's changed. It's the exact same idea, right? We are bearish. This is our area of supply. But instead of taking this trade, where I would just open the trade here and put my stop loss up here and take out this low for a 1-to-1. I'm waiting for confirmation. So this makes my supply and demand even higher probability because I'm not just taking it. I'm waiting for price to come in and clearly reject this level. You can see we come in bullish and now we're shifting bearish. You can see the clear rejection. Once we get the clear rejection, then I take my entry. And I just do the same thing that I would in this one. But instead of getting in here, stops here, I get in here and stops here. It's a much more refined area of price. And we can see how that plays out by looking at the 5-minute time frame. It's a beautiful entry in. Price starts moving away. Even in here as well, notice what's happening, right? This supply and demand is existing everywhere. Price sells off, price finds a new level of acceptance, right? Price ranges and then expands. Every time frame this is occurring. What happens? Price expands out, price comes back into this supply, and price starts moving away once again. And eventually we'll run through, and this supply zone holds the entire time. And that would be your trade idea complete. Now, if you want to guarantee that you'll become profitable this year, I've left for you a free training below this video. You'll see the link, click the link, watch the video. You will not regret it.